We want to focus right now in this next panel, which is presented to us by the Federal Reserve Bank of Richmond, on how investment and financing community issues are rethinking from global to local, and how you find innovative ways to raise, deploy, and facilitate capital to meet both local community economic goals and investor goals, including delivering a return on investment. You may recall that yesterday we invited you to send us your questions on how to raise capital for your commercial or social innovation. This is the panel that is organized all around your specific issues. This morning, they will now offer up their advice to the questions submitted by you. I will not have time to ask additional questions of the audience, so no need to email them in or send them in versus the app if you didn't get your question in on time. You will have one other opportunity because this entire panel has agreed to do a supplemental session right after the close of the forum where they will take additional questions and try to help you work through your particular situation. It is now my pleasure to introduce to you the moderator of our panel. William Burckart is an independent impact investment advisor who helps his clients integrate their philanthropic and investment goals through the sourcing, structuring, and execution of impact investment strategies across a range of sectors. He serves on the Working Capital Group of the National Micro Capital Task Force and the Global Advisory Council of Cornerstone Capital Group, and he co-founded Impact Economy. Bill is the author of Serving Client Demand for Impact Investing, a hands-on guide for financial advisors and senior management. He also managed the production of and is a contributing author to New Frontiers of Philanthropy and was involved in the writing of The Status of the Social Impact Investing Market, a primer. This is a report distributed to policymakers at the inaugural G8 level forum on impact investing. He, my friends, is a big deal. Please welcome him to the stage with a big round of applause.
Well, thank you, Anita. And I'm just now realizing I don't have a clicker. Where's my clicker for the? Is it right, perhaps here? No?
They actually click.
They click for me. Okay. All right, so thank you for having me here, and thank you guys all for coming to this session. I asked to do a few kind of framing remarks to start us off, because oftentimes when we talk about financing our market and community innovations, it gets very obscured and fragmented very quickly. And so I wanted to just step back for a second and focus in on this idea of impact investing. So investing with the intention to generate financial returns as well as measurable social and environmental impact. This has perhaps been the most buzzed about part of the sector, and so we'll start there. This is a topic where, if you want to go ahead and click, the White House has picked up on it as a way to meet public purposes. The UK, next slide, has used the presidency of the G8 to help catalyze a global market. Next slide. Even Pope Francis, so yeah, go ahead, one more. Even Pope Francis has identified impact investing as a way to combat an economy that often discards and excludes. One more. I'm half expecting at some point to see the world's most interesting man say, I don't always invest, but when I do, I prefer to achieve impact. Thank you. So this begs the question of, is all this hype really worth it? Is something new happening here, or is this just painting over things that we've already been doing? Well, the answer is yeah. On one hand, you have global climate change reshaping our world. You have this inequality in terms of wealth in developed countries and amongst developing countries. You have a scarcity of resources, water, energy, and other resources. And you have increasingly unfavorable demographics that are just some of the problems that are weighing on investors' minds as they think about where to place their capital. More than ever, they want to think about risk mitigation, and they want to be part of the solutions to these problems. At the same time, investors and consumers are responding to several trends changing the economy. So in the there's growing consumer demand in poor countries by low-income folks for cell phones, fuel, clothing, and all kinds of other consumer goods. You have the rise of the virtuous consumer in wealthier nations. These are the people that will buy, fair trade coffee, sustainably sourced peanuts, and they'll pay a premium for it. There's also a modernization of the welfare state in developed countries, particularly with belt-tightening measures in the USA, UK, and Europe. And there's a need for efficiency in terms of water and energy consumption, as well as minimizing the creation of waste by businesses. So this is all creating a number of interesting developments in terms of philanthropy, in terms of nonprofits, government, investment, and enterprise. This is happening locally, nationally, and here globally, nationally, and here locally in North Carolina. So you have foundations like the Mary Reynolds Babcock Foundation that is using investment as well as grants to further its mission. You have interesting startups like RevTech and City Startup, both in Charlotte, that are utilizing new SBA growth acceleration funds. You have things like Durham Connect's social impact bond. They're exploring this idea of a pay-for-performance contract with government, where investors essentially put up money, and as a cost savings to government, they're paid back if certain social outcomes are met. Durham Connects is focusing on childhood emergent care and kind of decreasing the number of visits that infants have to make to the hospital. You have nonprofit community development organizations like Self-Help that have helped create a secondary market for affordable mortgages for low-income and minority homebuyers. You also have major financial institutions like Merrill Lynch that are helping to democratize impact investing by offering, say, World Bank green bonds to $1,000 increments for retail investors. You also have something direct public offerings, which Jenny will talk about, as another tool for raising capital for entrepreneurs. So with all these convergences happening, so whether it's nonprofits and philanthropists developing a more business or investment orientation, or investors and businesses developing a more social or environmental orientation, you have the beginnings of a paradigm shift. But we have what I like to call the Rod Stewart problem. I helped do the New Frontiers book, which Anita mentioned. And so as a good son, when it was published, I sent a copy to my mother. This is at her home. This is not staged. I go there and see that the book has become this very elegant coaster for Rod Stewart's Great American Songbook. Now, if you'll notice, the book has no dog ears or notes. It really hasn't been touched. But now the Rod Stewart album, cracked CD case, it's been used within an inch of its life. And it highlights this bigger thing. My mom is someone that could engage in philanthropy, impact investment, and she works with entrepreneurs. So she doesn't see her digestible entrance point yet. And that's something that investors of all sizes and shapes are struggling with. Where do we come in? Where's the right stage of capital? What kind of capital? All struggling to get off their assets. You have the kind of practical, legal, cultural, and capital stands beneath all of the kind of entrepreneurs and enterprises and nonprofits. Literally, that sand is shifting beneath their feet, and where the stabilizers are is very unclear at this point. You also have this kind of alphabet soup of measurement, that there's a lot of metrics out there, there's a lot of systems, but they're so complicated that a lot of folks just can't use them. And certainly across stakeholders, creating alignment is really tough. So this is a cartoon from the New Yorker. It's wolves howling at the moon that says, my question is, are we having any impact? You also have this question of what is the policy environment that's going to help enable this? So policymakers are trying to embrace this nascent market closely, but not too tight that it stifles innovation. So it's against this backdrop that we have this panel. And this is an image from The Land Before Time, one of my favorite cartoons growing up. And we have assembled our own kind of little fellowship of Petrie and Littlefoot and Sarah, the Triceratop, in our panel today. So I'm going to go ahead and introduce our panel. So we're going to have Scott Case. Dan Nissenbaum, the managing director of Goldman Sachs Group. Dan used this opportunity for a little mini college reunion down here. That's why he's here. He also just arrived this morning, so he's well caffeinated. We have Scott Case, who is the founding CTO of Priceline and the CEO of Main Street Genome. Scott is a fan of funky shoes, and if Scott can, I don't know if you can show, he's living his dream right now. And then we also have Jenny Kassan, who is the CEO of Cutting Edge Capital. And the last time Jenny was here in North Carolina, she was 91, and she was dyed her hair, and her and her best friend, were doing their own version of Thelma and Louise. So glad that turned out okay and that you could join us here. So let's hop into it. Basically what we're going to do over the next 40 minutes is talk about the real benefits to this movement towards this kind of convergence of market and community innovation, and what that means in terms of facilitating capital, directing capital. We're going to talk about some of the challenges, and then we're going to get into breakthrough opportunities for pushing this field forward. So I want to go ahead and start with Scott. When you look at a lot of the data, they talk about the wealth transfer of wealth from boomers to millennials, and how this kind of preference towards achieving impact with investment is going to only increase. At the same time, you have the majority of CEOs responding to an Accenture survey saying that sustainability would be a core feature of their competitive edge going forward. How are all this backdrop of trends and changes, how is all of that influencing your work and what you're seeing either at Main Street Genome or at Startup America?
Well, thanks for having me here. They're Spider-Man sneakers, in case you were wondering. So a couple of things. First off, there's a giant opportunity. There's trillions of dollars in play here. And even if you just look at it, not only from individual wealth, but the increase in the number of foundations that have been being created by families to help to figure out how to transfer some of that wealth. But even if you just look at the philanthropic structure of foundations, they're a couple of $1 trillion in capital, and the current structure requires them to put about 5% of that to work every year. So that leaves 95% of those trillions of dollars kind of locked up. And more foundations, Rockefeller foundations and others, have been moving to try to figure out how do they align their corpus investment strategy over the last decade much more aggressively into the impact side. But there's one really big challenge. And I'll just focus on the foundation side, but it's really across the capital spectrum. The biggest single challenge is that they are focused on the corpus side of managing this capital on financial returns. And we have a couple of 100 years of understanding how to measure capital returns. We have return on investment, we can look at balance sheets, we can look at cash flow statements, we can compare investments across categories using those basic tools. We don't have any of that on the impact side. We've got a lot of complex social impact measurements, but we don't have anything that allows us to really understand what's going on now. The impact reporting and investment standards is like probably the best we have at the moment, but it's really complicated. Hundreds of different metrics that you have to measure, and most of them are focused on activity metrics. Very few are even focused on output or outcome metrics, and we're really far away from actual impact. So when we think about impact investing as a broad category, we are still primarily measured on the financial return. And I'll make one last comment on that point. The financial return, we're still a little hung up from an impact investment side on preservation of capital being the floor of what we're managing against. That's not how the rest of the investments work. In fact, if you look at any investment portfolio, if you're not having losses in the portfolio, you're probably not maximizing the return. But we don't think that way on the impact investment side. We're trying to figure out where the floor is on capital preservation, or slightly less than market rate return, or we're playing for market return. And you look at the studies about people who are impact investing, something like 40% of them are looking for a market rate return. They very rarely talk about, well, if you had a sub-market or even a loss rate return, but we had a massive social outcome or even impact, would you be willing to make that investment? So one of the things that I worked on was I spent about 5 years running an organization called Malaria No More, where we worked on ending malaria deaths in Africa. And I can tell everybody in this room, if you give Malaria No More $10, we'll make sure that a family in Africa gets a mosquito net that will reduce the chances of them getting bitten by malaria by something like 10 times. In fact, we've cut the rate of malaria deaths in Africa by about 60% over the last decade using these kinds of tools. Guaranteed social return on investment. You will get zero financial return on investment. Guaranteed. I can guarantee you'll get zero return on investment, but you'll get a very positive social return on investment. We don't know how to reconcile those yet. And so that's one of the biggest single challenges that we see. So it's a huge opportunity out there. But we've got to figure out ways, and collectively as investors, to move past this basic floor of capital preservation and get real about the fact that there may be times where you have a loss in the portfolio from a financial standpoint, but we have a massive gain on the social side. And we don't quite know how to reconcile those things just yet.
Dan, do you want to jump in on that?
Sure, thank you, that's great. I come to you, and I think my perspective is one as, from a couple of seats. One is as a CRA investor. I've been doing that for many more years than I'd like to admit. Number two, our group at the firm at Goldman has launched a social impact fund, and we're out raising money. We have raised money from high net worth investors as well as from foundations and other institutionals. And I think your comments around sort of how different folks look at investment returns, a risk aversion, less of an interest in what the return is, a lot more interest in what that floor is sort of fascinating. Our group has also innovated and launched and closed the first 4 social impact bond financings, really, again, not a bond, they're really social impact loans. And we've done 4 of those, which I think are really important to talk about. Really, they're more broadly pay-for-performance financings. And lastly, we have a corporate-wide initiative called the 10,000 Small Businesses Program, which is serving entrepreneurs with both management education and capital. So there's a lot that's going on in this space. I think, you know, the topic I know people want to hear about is really the access to capital issue, and I think we can get to that from a couple of perspectives. It's very clear, and I don't think it's news to anybody, and the Fed has taken, I think, a leadership role in highlighting this, that there's a huge credit contraction going on at the moment since the recession. Large banks have really tightened the credit box. They're under a lot of pressure, be it regulatory issues or capital issues, but the fact is they're not really serving the lower part of the market. Small businesses, and we're talking about smaller businesses, are really still trying to recover. They don't have the same balance sheet strength. They don't have the same amount of collateral with which to go and borrow. And interestingly, one of these Fed studies that just came out talked about actually a weakness of demand for credit under $1 million and for smaller businesses. So there is really a kind of a paucity of help out there. However, through pay-for-performance and social impact bond models, and through some of the models that we've launched in our Community Reinvestment Act work with lessons that I think could be brought to North Carolina, there are terrific models to talk about, and hopefully we can get into that conversation a little bit more today.
Yeah, and I would just like to say, on this kind of theme of the benefits of this movement in this direction, Jenny, you focus on an area or on a tool that's completely underutilized here in North Carolina, so maybe you want to talk a little bit about that?
Sure. So I come at this as a lawyer. I went to law school, and I actually I worked as a lawyer for about 10 years before I really knew much about the law governing investment. And then I learned a bit about it. How many people are familiar with the concept of an accredited investor? Okay, so maybe 10%. Yeah, and don't feel bad if you haven't heard of it, because I hadn't heard of it either, even though I had gone to law school. I was working with small businesses out of law school. And when I found out about it, I was quite surprised. It's actually a concept under securities law, which is the law that governs capital raising. And it defines an accredited investor as someone who has at least $1 million in net worth, not including their home, or $200,000 in annual income, or an institution or an entity with at least $5 million in assets. And it's quite a small percentage of the population. And if you happen to meet that definition, the securities laws assume that you don't need quite as much protection from bad offerings of investment opportunities. So from the business side of things, if you're only raising money from accredited investors, there's much fewer hoops that you have to jump through. And so what that means is that those of us who are not accredited investors really don't have that many options of what we can invest in. We really, we have the opportunity to invest in mutual funds, CDs at banks. But if you want to make an impact investment in something that's maybe right in your own community, it's very difficult because of these laws and the traditions that have evolved around these laws. Oftentimes you won't find an opportunity to invest in a small business that you might really believe in. And of course that has a negative impact on both sides. Investors don't get to invest in the things they might really want to invest, and they might be forced to put money into something they don't feel really good about, for with their retirement accounts or any extra money they have saved up that they'd like to invest. And then at the same time, small businesses are deprived of a huge amount of capital that they could possibly have access to if regular folks could invest in them.
Yeah, and I think what you're probably picking up from all their comments is that for as exciting as the potential is with all these new financing mechanisms, there's a normative dimension here, that it's not necessarily easy and that we haven't necessarily figured out how to make a really thriving ecosystem yet. And so I want to get a little bit into the challenges then, because that's kind of, I think that's what we're all here for, right? We want solutions. Now go into a quote from U.S. Treasury Secretary Jacob Lew, who said that each workday more than 8,000 businesses and communities across the country fail to qualify for a commercial bank loan. This creates a huge capital gap. And these requests for credit are declined because applications are too expensive for banks to evaluate and serve, not because all of the businesses are inherently too risky. And that with current, most of these are creditworthy using underwriting methodologies currently available on the market. Where do you think the disconnects are in the system? And maybe, pop the hood a little bit. Take us around in there. Dan, why don't we start there?
Sure. So again, I think it starts with the credit contraction, but actually I think we need to take a step back. One of the things that we learned in our 10,000 Small Businesses program, and we've now had 4,000 people go through the program, is that a high-quality management education is actually as important, if not more important, than just purely getting somebody a loan, although we know small businesses need access to, frankly, both equity capital as well as debt capital. It's been fascinating, actually. Our education program, which is delivered through community colleges in association with Babson, folks go through, it's 100 hours, it's 10 weeks. They really step out of their business to work on their business, which they never think is possible when they enter the program. And we basically have tried to provide a seamless approach. If you come in, we'll provide management education, we can provide capital, and we'll provide business support services. What we found, actually, is that simply by going through the management education program, where actually each company works on its own business as the case study, oftentimes people realize maybe they shouldn't take on debt. And it's been a fascinating learning. Although conversely, those companies that had been able to take on debt increased their ability to get more capital by about 5x. So these companies have increased revenue, have added jobs, have better access to capital. And frankly, another interesting thing that we saw is that it decreased the wage gap between women business owners, who are about 50% of the folks in our program, relative to men. Male business owners. But overall, I would just say on the small business side, and we should touch on the online lenders now, which I think has been the most disruptive force, not only just for banks, but also for small businesses, some positive, some have some concerning, as well as for CDFIs, which you touched on earlier. Again, there's been a contraction.
Could I just say,
Sure.
so we saw the news yesterday in Wall Street Journal that Lending Club has partnered with a number of folks to help essentially facilitate this peer-to-peer lending. Maybe you want to touch just a little bit on that. Just a lot of folks, when they think about this, they think of predatory lending, but should we throw the baby out with the bathwater, or is there a there that could really help folks?
Yeah. Well, look, this transaction which was mentioned yesterday is, again, a number of community banks who have, I think, struggled to generate loan demand on their own, who are facing more burdensome costs, compliance issues. In fact, many are consolidating. I think they're just not good at generating pipeline, right? So what they've decided is that if they get together as almost like a co-op and adopt Lending Club as their sort of front engine, their loan demand engine with actually a decisioning, they can actually generate assets more readily with a lower risk profile. So I don't think it's throwing the baby out with the bathwater. There's a real polarized view at the moment. Some folks say, this is terrible, this really sounds and looks like all of the makings of the subprime crisis we just went through, loans that are being generated by brokers, loans that are short-term in nature, loans that can be high cost in nature, all sort of smelling like there's kind of an aggregation and a securitization strategy. And it's too early to tell about that. And so what I think will be interesting in this particular example is that those loans, which are short-term, small dollar, $30,000 on average, really kind of working capital loans. If they do get adopted and taken on by the community banks, they'll be in the regulated system. And I would think that's something that the world and regulators should probably appreciate. So it's disruptive. It is getting capital to small businesses faster. There are these issues to be concerned about. Right now, I think we're very early stages, and this requires a lot of focus and the scrutiny of regulators, and we'll see where all that goes.
And I would go to Scott. Yeah, I mean, you've talked a lot about how the enterprises at different levels need as much of the capital as the other intangible support. Maybe talk a little bit about that.
Yeah, so I think that 10,000 Small Businesses is but one of a lot of different programs that are out there, probably one of the biggest, focused on this management issue. When you look at particularly Main Street businesses, which is what my company focuses on, so think businesses between about $500,000 to $25 million in revenue. There's about 2.3 million of those businesses, and they're in every one of our communities. It's your dentist, it's the restaurant owner, it's the plumber or the electrician that's in your market. And these businesses, when you get under the hood about how their business actually operate, the kind of things that your program do, where you mention a case study of their business, a lot of times the owners start to realize like what business they're actually in. You know, they got into the business and with all their enthusiasm and their heart and their energy, and they're grinding it out every day, and they've made it a working and a going concern. And they think that if they brought capital in, that would be the answer to some of their questions. But oftentimes I find, and this is both true with startups and with Main Street businesses, sometimes they confuse capital with customers. Like the actual problem is that, you know, we need to drive more customers, and oftentimes they don't even think about the investment in those types of things. It's not their fault. They're making their way every day. But I think one of the big challenges is that when you look at these kind of lending tools, they're really about optimizing payback on their own capital. Right, so everything is about figuring out how, if I put this loan out there, am I going to get my money back? And their risk assessment is really about, especially for the merchant processing ones, how do I attach myself to the revenue stream and essentially pull money off of that stream where I get to eat first? And so I think from an operating standpoint, a lot of small business owners don't think about what that impact is going to have on their cash flow, on their business, partly because they don't understand how their business operates necessarily. And so at Main Street Genome, we looked at a lot of businesses where they would have cash flow issues, and they would have these seasonality problems where the timing of their expenses and the timing of their revenue was off. And if they just managed it better, they would not need any working capital. But they didn't understand how to even look at the financials of their business in an operating kind of a way. So I think one of the challenges, you've touched on a lot of the regulatory ones, I think it's brutally pragmatic. A lot of Main Street businesses just need to understand their businesses better as they look at their capital front. And maybe they need capital, or maybe they actually need a better understanding of their business that, sure, maybe capital is the answer to their particular challenge. But I think we're coming into a kind of the next generation of business owners that, frankly, are a little bit more savvy about kind of the business operations that they have, but they're still lacking a lot of the basic financial understanding and blocking and tackling that would allow them to go and move in that direction. And my final point on this is that the distance, you brought up community banks, that part of the challenge in their cost structure is that even community banks have gotten further away from their customer. You go and sit down, and I challenge anyone. Anybody here a small business banker? Anybody in the room?
I was.
Okay. Well, the big challenge is that you're looking for customers that generate about $5 million, so that's your floor. So anybody underneath that, you're sort of not interested because you're not compensated for anything that's smaller than that. Just opening an account, forget anything else. And then further, we've gotten further away. It used to be that, you know, I coach my kids' soccer team, and the small business banker would know about my business. We're way away from that. You talk to most small business bankers, they don't know how these businesses work. There's 50 different, 60 different, 100 different business types. They're not experts in all of them, so they don't know how to evaluate them. And on the other side, you have a business owner that isn't an expert in their own business. That's a recipe for, I'm not going to touch this. Right? And we've got to figure out a way to collapse that gap. And, you know, data and information can help us do that, but we've got to think about it differently. And again, I'll point out the current way we're using data and information is, can I get paid back? And I know that's, you know, I have friends of mine who started at some of these companies like Lending Club and On Deck Capital and others, and they're from a startup standpoint really smart. Tap that revenue stream and make sure that you get your money back first. From a startup, that's great. But on the other side of it, is that really what we want on the small business side? Sorry, go ahead.
I was just going to say, quick anecdote. I mean, the article yesterday, the greatest source of demand that these community banks hope for this product will be their own customer base. Yeah. And instead of walking into their branches, they would call or whatever it would, and then they just get referred to the website. So that's actually really underscores, I think.
Yeah.
And Jenny, some of these kind of regulatory or pragmatic dimensions, how are they reflected in your own work?
Yeah, and I realized I didn't answer your question the last go-around. You asked me about tools that are currently available. I talked about the problem, and I didn't talk about the solution that I've been working on. And I think, so just generally speaking, this issue of lenders being so concerned about getting their money back and, you know, wanting to be the first one to get the capital, you know, the cash flow out of the business, I think one solution to that is spreading the risk and spreading the rewards as well among regular folks. And so what I work on is a tool called direct public offerings. And what that is it's a legal tool where we deal with the securities laws and make sure we're in compliance with them, but it allows our clients, who are small businesses, to raise capital from everybody. And a lot of people don't understand that this is legal now. You might have heard of the Jobs Act that was passed in 2012, and there's a portion of it that will actually create a new tool for doing this, but there are legal ways to do this now. And we have clients that have been very successful doing this. Just as one example, we have a client that is a pickle company based in Western Massachusetts called Real Pickles. They're very, very committed to their region, purchasing from small farmers, supporting the local economy. Even though they have the opportunity to sell all over the country, they really don't want to because they are just so committed to their local customers and their local suppliers. And we helped them go through the regulatory process that allowed them to raise money from anyone, residents of Massachusetts and Vermont. And they sold, in their case, they did sell equity, non-voting preferred stock. And they're actually a worker co-op. So the company is controlled by the workers. Their equity investors don't have any control. It's non-voting, but they are offered the possibility of an annual dividend of 4%. And they were able to raise $500,000 that way in about 2 months. And the minimum investment, I believe, was about $2,000. So they ended up with about 75 investors. So they're really spreading the risks and keeping the rewards in their own community. So they don't have an outside investor, you know, taking that money that's coming out of their success and taking it out of the community. People are in the community are benefiting, and that wealth is being regenerated and recirculated within their community.
So, did you want to?
No, I just think it's remarkable, and as you're speaking, I'm thinking about sort of the continuum of debt financing, which I think we spent a lot of time talking about. Somebody who starts off with business credit cards and then maybe a micro loan, and then they sort of fall into this big gap before they could get a loan above $1 million. And I don't know as much about this space, but the equity arc is sort of interesting. Friends and family, kind of angel. And then I think for these smaller businesses who may raise, I don't know, $500,000 or $1 million, you're kind of stuck because to raise equity, you'd have to go to a VC or something like that, and those are probably much bigger checks. And I think back to your earlier point, Bill, I wanted to bring us back to impact investing. You know, we're talking about programs that connect capital with businesses. And I think in the impact investing space right now, I'm sitting in a bank, but right now I think a lot of people are eager and it's enticing to think about the amount of wealth that's being transferred, high net worth investors, excuse me, that was a Freudian slip, venture philanthropists. I've heard that word before. And so, you know, right now I think we're in this space where there's a lot of capital that needs to be connected, and there are different ways to intermediate that. Whether they're CDFIs or direct public offering, I think we're at this moment where there's a lot of different models coming, but right now impact investing means a lot of different things to a lot of different people. And the capital, the large pools of capital we're all trying to look at, pension funds, insurance companies, et cetera, their smallest check that they can write for a bunch of different reasons is such a higher number than the biggest opportunity that's being offered right now in the community space. I just think that's a really interesting problem, and hopefully we can talk a little bit more about that.
I think that's actually a good transition point to start talking about what are those breakthrough solutions that are needed. I'm going to read something from, so Steve Case, one of the co-founders of AOL, he's been at the forefront of venture philanthropy movement and impact investing particularly here in the U.S. And he came out with this 5-point plan for spurring U.S. entrepreneurship and essentially unlocking capital for mainstream entrepreneurs. And he has a couple points. So one is modifying the Community Reinvestment Act and the Community Development Financial Institutions, accelerate impact investing through greater use of program-related investing, which is through foundations, build a regulatory roadmap that would clarify the regulatory landscape faced by these new businesses, empower the next generation of entrepreneurs by creating an annual national entrepreneurship competition. So does that get to it? Well, I mean, where is that right? Where is that wrong? And how should folks in North Carolina think about this in terms of incentivizing this ecosystem? Why don't we start with Scott? We ended with Dan.
All right. With full disclosure, Steve Case and I are not related to each other, although we worked together for a really long time, including on Startup America. So I'll peel off one piece of this puzzle around, specifically around high growth startup communities, of which different types of equity capital tends to be a key priority. But a big part of the work that we did at Startup America, now an organization called Up Global, which is at up.co, is focused on how do you help thriving startup, mostly cities around the globe. We do programs in about 600 cities around the world and about 200, I think it's about 200 cities here in the United States. And it ties back to some of the programs that we did at Startup America. There's a Startup North Carolina, there's a Startup Texas, there's a Startup Colorado. And these are groups of mostly individuals, usually entrepreneurs, that are focused on how do they make better connections for startups and high growth companies within their communities. And at Startup America, we identified basically 3 things that were critical to these communities being successful. The first was centering them around the entrepreneurs themselves. And I think that's something that, for those of you who are policymakers or large enterprises, it gets lost. Like, we try to do things for or to entrepreneurs. We don't actually help enable the things that they are the ones that are leading, and that they have their finger on the pulse of what's required in their communities. So number one, it's entrepreneurs. Second is it's connective tissue. A lot of the people in this room are connecting with each other, maybe for the first time, maybe you've known each other for long periods of time, but the number of connections and the density in a given market is a critical driver. And then the third piece of the puzzle is really about driving a lot of basically activity that fosters the second bucket. It's about having activities and opportunities, and like, I love the fact that throughout this conference, you've got pitches from local business owners who are talking about what they're doing. It's really critical, because if you want to have more entrepreneurs, you have to be able to see those entrepreneurs and define them as entrepreneurs and give them visibility, and that's an example of that sort of celebration and activity around them. So, 5-point plans come and go, and Steve and Carly are super smart, and they came at it, I think, very thoughtfully. But at the end of the day, it's a pretty simple stuff. And if we're going to empower entrepreneurs, and we're going to put entrepreneurship sort of as a core asset of our country, which is really, we've had the benefit of having entrepreneurship drive everything without having to do a lot of effort. We've sort of been like a natural athlete as a country, like we've just been able to be good at it. But the reality is that the rest of the world is sort of catching up to us. And if we don't invest in that, the last panel was about education for entrepreneurs, if we don't invest in helping entrepreneurs that are running their small businesses today and get smarter about how they run them as business managers, we've got to invest in that category sort of across the board. And everybody in this room that's playing a role in engaging with entrepreneurs, whether it's from a capital standpoint or education standpoint, or even just an advice and counsel or networking standpoint, they're the center point of the success of all of this. And the more we can make the road easier for them, the better. But if we're not focused on the entrepreneurs and the founders, we're not going to get there. And I'm out of curiosity, how many people in the room have founded a company or are running a company right now of any kind? Okay, so everybody, just keep your hands up for a second. Everybody around you, look at the people with their hands up. Our job is to help them, okay? They're the people. So go find them in the interims of things and figure out ways that you can be useful to them, because they're the ones that drive everything.
And Jenny wants to get you equity, and I want to get you debt. So let's all meet right afterwards.
There you
We
go.
can actually do equity or debt.
Oh, the race is on.
Fantastic.
Get the better deal from one of them.
So Jenny, do you want to hop on that too? I mean, where do you think the gaps are? Where do you think the biggest points of progress could be?
Yeah, I think that we have a lot of tools in place to really make a big difference. I mean, a colleague of mine named Michael Schumann estimates that if we unleashed the money that unaccredited investors have to invest to allow them to invest in Main Street businesses, it would be a $15 trillion shift. So I feel like, and that's without any policy changes. So I feel like we actually have quite a lot of options out there that are already available, and it's more an issue of raising awareness of the tools. I did go ahead and look at the North Carolina statutes and regulations, and you happen to have in North Carolina a very straightforward regulatory system for doing this here. So I highly recommend talking to a local attorney, or if you can't find a local attorney who has experience doing this, please get in touch with us at cuttingedgecapital.com. And we also, if you want to kind of see what's already out there, we're trying to create an ecosystem to really raise awareness of these opportunities and also to support entrepreneurs and investors that are trying to do this type of crowd financing or investment crowdfunding, whatever you want to call it. Direct public offerings is what we call it. So we have a website called CuttingEdgeX, the letter X.com, and that's where we list opportunities that we're aware of to do impact investing, where the opportunities are open to everybody and not just to accredited investors. And I'll admit there's not a lot up there right now, and they tend to be state by state. Some of them are open to just about everybody. Some of them are open to 1 or 2 or 3 states to invest in, but please bookmark that so you can keep going back, and hopefully we'll get to a point where we have hundreds of opportunities there for small businesses that are raising money to be able to connect with investors that want to support them.
My website's not that cool. It's just gs.com. We're easy to find. I would say 3 things. One is reform CRA. The second thing is expand social impact bond or loan type financings. And the third one is support CDFIs, and let me spend 2 seconds on each of those. Look, in terms of the Community Reinvestment Act, and I've been in this business for over 20 years, I'm a believer in the CRA. Despite popular opinion, it did not cause the subprime crisis. That's a whole other conference. But we'll be in such a better place when people want to make these investments rather than are being obligated to make these investments, be they banks or pension funds or insurance companies or high net worth individuals. CRA does need to be reformed and overhauled. The regulators are trying to work on that. That's been a tough battle. CRA really tells a bank where to invest, how to invest, and when to invest, and that is just an artificial sort of restriction. A lot of good things that are done. Billions of dollars are invested by banks. We need to expand the geographic footprint, and everybody should really care about what happens to CRA at this time of consolidation of financial institutions. So you should know about it. You should be advocating for its support. And one of the most acute issues, again, is that the law is about over 35 years old at this point, and it says a bank should invest where it does business, which is sort of reflected in its branch footprint. I'm Goldman Sachs. I don't have branches. I have these areas which are delineated for me. We'd like more flexibility. Retail banks want that same flexibility. We should be directing capital to where it's needed, not where your bank sits. Delaware, for instance, you can't imagine. There's tons of banks and there's only a few people to give money to. Pay for performance. We've been, without going into great detail, although this is something we're enormously proud of, these pay for performance structures, these social impact loans are bringing capital to really very difficult social needs, recidivism, high quality early education. These are needs that are not well met by philanthropy and are not well met by CRA, which is more targeted to facilities in many cases. And we're early days on that. There's just a few deals out there. They're small in scale. We need to really expand that market and bring a lot more to bear there. Lastly, community development financial institutions. They're our capital partner in the 10,000 Small Businesses program, but they're legit financial institutions. They're unregulated but certified by the Treasury. They are great capital stewards. They leverage a small amount of government financing, about 20 to 1 in terms of attracting private capital. They have a phenomenal track record of lending to not-for-profits, to small businesses, to homeowners, and they've got a great performance track record, and we should be doing all we can to help support them.
Okay.
Can I jump in really quick about CDFIs, community development financial institutions, and there are others that are sort of like CDFIs. They're not officially CDFIs, but they make very small loans to small businesses. We actually have some clients that are those kinds of lenders that are doing these direct public offerings. So they're raising money from their community. For example, we have one in Mendocino County, California. It's a small CDFI. They're raising money from their community. The minimum investment in the form of debt will be $1,000, and they'll be lending that money out to small businesses in their community. So direct public offerings can be used for businesses that, for operating capital, or for nonprofits, including CDFIs, to lend out to other businesses, or even just nonprofits that generate revenue can even do direct public offerings. We have one client that's a school. They generate revenue through tuition. They're also offering an investment opportunity, which in their case would be debt, because nonprofits can't do equity.
Okay, so in our last minute and 30 seconds, because I feel Anita behind me, why don't we do just, I loved the cybersecurity panel ended with that. What is that one thing that the audience can do today, tomorrow, that is going to move them in the right direction? Why don't we start with Dan, because you just arrived this morning, I'm going to put you on the spot.
I just gave you 3 things.
And you said, I know, well, even if it's an echo, give us the one concrete thing.
I think the one thing that I think people could generally do is really advocate around CRA. That's probably the most tactical in terms of approach.
Okay. Scott?
I think if you're in the community space and looking at ways from an investment standpoint of any type, it's really focusing on the entrepreneurs themselves and getting a much deeper and better understanding about what's going on with the entrepreneurs in your community, by they, high-tech startups or their local mom and pop, restaurant. We just have to get much, much closer to the entrepreneurs to really understand what the capital needs are, how they run their businesses, and what the best way to support them is.
Jenny?
I would say to make sure that you and everyone you know is educated about the possibilities of raising capital in North Carolina from North Carolina residents, and get really savvy on that. I think the law you have now is perfectly great. Get to know your securities regulators and make sure they're on board. Sometimes we've found that even when it's on the books, the securities regulators don't know about it. So start using it.
Awesome. And with 6 seconds, 5 seconds, thank you guys so much. Round of applause for our panel.
Thank you.